Ladies and gentlemen, good day and welcome to Control Print Limited earnings conference call hosted by Asian Markets Securities Limited. As a reminder, all participants' line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Karan Bhatelia from Asian Markets Securities. Thank you, and over to you, sir.
Thanks, Bilal. Ladies and gentlemen, good afternoon, and welcome all to the Control Print Limited 2Q FY22 earnings conference call hosted by Asian Markets Securities Limited. From the management side, we have with us Mr. Shiva Kabra, Joint Managing Director, and Mr. Rahul Khetri, CFO. I now hand the conference to Mr. Rahul for his opening remarks, and then we can open the floor for Q&A. Over to you, Rahul. Thank you.
Thank you, Karan. Welcome everyone to the second quarter FY22 earnings conference call of Control Print. We appreciate your taking out time from your busy schedule to attend the call. Hope you and your loved ones are safe and healthy. Mr. Shiva Kabra, Joint Managing Director, joins me on this call. Let us start with a brief on Control Print, followed by specific analysis of the financials of the current quarter, and end with the Q&A session. The detailed presentation has already been put up on our website as well as in the investor presentation notification on the exchanges for this call. For those who are probably reviewing the company for the first time, Control Print is in the niche coding and marking segment, which is an oligopolistic market with 4 major players, 3 of whom are MNCs, and Control Print is the only Make in India manufacturer. This gives us an advantage to sell our products locally and compete strongly with the other multinational players. We are the only integrated player with capability to manufacture both printers as well as consumables in India, giving us an advantage to share the benefit with our customers. This also gives confidence to customers for long-term partnership with Control Print. We have our manufacturing facilities in Nalagarh in the state of Himachal Pradesh for the manufacturing of printers, and in Guwahati in the state of Assam for the manufacturing of consumables. Both the manufacturing locations are state-of-the-art facilities to produce good quality products. All our consumables are manufactured in the Guwahati plant, and in addition to this, we have also started manufacturing some printers in that location. We have a strong sales and service team of 350 plus engineers across our 11 plus branches, which gives us the advantage to service our customers efficiently and timely, since after-sales service is very critical to ensure that the production lines of the customers continue to function continuously, thereby maintaining customer satisfaction. The 11 plus branches across North, South, East, West and Central India gives us the advantage to be in direct contact with all our customers in a timely manner, since our products are critical to their production process. Post sale of printers, there is a continuous demand for consumables over the life of the printer, which typically lasts for 5 to 7 years, depending on operating conditions. We have our complete attention on our customers' requirements to ensure their production is never affected and service requests are attended immediately, thereby gaining our customer confidence. We have an end-to-end ERP system set up which ensures maximum transparency in accounting, sales and after-sales service, as well as total control from raw material planning and ordering to receivable collections, and is integrated with our CRM system, which gives the confidence to the team, the customers, as well as our auditors and investors. We have a widespread customer base catering to multiple industries like pipes and cables, metal, automotive, food and beverages, FMCG, pharma, etc. And we continuously endeavor to customize our products to reach out to other industries to increase our installed base. We have the entire range of products in our portfolio to meet the coding and marking requirements in the industry. The details are elaborated in our company presentation. As of today, the company has an installed base of 14,000 plus printers across industries, which enables the sales of consumables across the life cycle of the printer. We are very confident that we have the best-in-class products to meet the requirements of most of the substrates, which gives an additional advantage to the customers to do business with Control Print. With a strong foundation and 5 pillars, that is man, machine, material, technology, and finance, well established to augment our business plan, we are confident, continuously striving for greater heights. Sorry. Let me give a brief analysis of the financials of Q2 financial year 21-22. The manufacturing activities in Q2 was encouraging and gives an indication of the recovery of the Indian economy. The Index of Industrial Production, the IIP, has also shown an upward trend in the last few months due to increased production across industries. With the decline in the COVID infection rate and the increased vaccination, the fear of the third wave is much diminished, and the mood of the nation as well as the industries is optimistic for a quick bounce back for higher growth expectations. There was a strong traction witnessed both for consumables as well as printers, as the companies were increasing production as well as capacity. These are extraordinary situations when the strength of the company is tested, and we can assure you that Control Print is geared up for any challenge. We are financially stable and robust and will continue to perform in spite of the unforeseen challenges. This stability of Control Print has also been reaffirmed by credit rating agency CRISIL with an A rating after considering the short and medium-term impact of the COVID pandemic. Our investors can maintain their belief on the company's management for an optimistic future. This quarter's performance delivered an all-round growth in revenue and margins and volume growth. We achieved the highest quarterly revenue of 62.72 crores with year-on-year growth in revenue of 18.2%. Also sequential growth in revenue of 15.3%. The reason for growth in revenue was due to good traction in consumables as the industrial production across most of the industries increased, though it is not comparable as Q2 of previous year was partially affected by lockdown. The profit before exceptional items increased 32% year-on-year, increased 36% for the half year, and increased 38% sequentially. The profit before tax increased 30% year-on-year and 80% for half year. The EBITDA increased 23% year-on-year and 31% for half year and witnessed highest quarterly EBITDA. The working capital days improved significantly by 21 days quarter-on-quarter and 30 days half-yearly due to better inventory management and receivables recovery. The company maintained healthy margins with profit before exceptional items at 18.9% and EBITDA at 25.5%, with further scope of improvement due to better product mix and higher revenues triggering economies of scale. We should continue to maintain the EBITDA margins north of 24% on a long-term sustainable basis. Let me brief you on the performance of various divisions, products, and business segments. Printers had a positive demand in spite of a challenging environment, though the installations were slightly delayed. The increased install base will drive the business in the coming quarters. The company received a large repeat order from the dairy segment. We have received pan-India success in the sugar segment with key customers for the upcoming sugar season. The flagship division CIJ witnessed traction with growth of 15.5% in half year as the production of the customers was increasing. The growth was mainly due to improved production of some of the industries where we have a stronghold, like dairy, healthcare, food, cable and wire, agrochemical, and was also encouraging to see growth in some of the upcoming sectors like pharma, paints, and wood. New product launches of TIJ, TTO, and high-rise are showing good traction and with some good installation in the past few months. We have dedicated managers and teams to drive these verticals with focus on dairy, beverages, bakery, frozen food, ready-to-eat, pharma, packaging, plywood, lubricants, and carton coding. These new products continue to grow every quarter, which builds confidence on the potential of these products in the coming years. Laser printers business is growing steadily as product technology has improved and a new team is driving the business. This has yielded good dividends with positive response from customers and new opportunities expected in the coming quarters. Service revenue has also shown good growth in value terms, which contributes towards profitability. Our strategy to separate verticals for key account and OEM business for focused approach is showing encouraging results and should yield good quantum of business. LCP business reported an increase in the previous 2 quarters with some revival in cement accounts and pan-India supplies in sugar industry. We are changing our focus to non-LCP business and some new applications, and the team is confident of generating business in the coming quarters. The company has strong cash flow and the trend is expected to continue. CONTROLPR retains its position in the list of top 1,000 companies on the stock exchange by market cap on the National Stock Exchange. While the pandemic retreats and with the increase in the vaccination population will result in robust growth of the economy, and we hope for similar trend of growth trajectory. Fundamentally and inherently, the company remains strong and we are focused on our plans and strategies as we are confident of the growth potential to drive positive results. The floor is now open for questions. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask any question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may please press star and 2. Participants are requested to use handset while asking a question. To ask a question, you may please press star and 1. We have a first question from the line of Gaurav Shah from Harshad Gandhi Securities. Please go ahead.
Hi. First of all, congratulations on a good set of numbers. I have a couple of questions. First is with respect to the EBITDA margin. Do you think that the EBITDA margin of around 25% this quarter is sustainable, especially with the energy prices going up recently? And my second question would be with respect to the sales growth. Do you think we can achieve growth of around 25 to 30% going forward with the manufacturing picking up in India? Yeah.
Thank you for the question. Yes, I've mentioned in my presentation also that EBITDA margin above 24% is definitely sustainable. We have always maintained this stance, and I think anything between 24 to 28% is what we have previously also given the guidance that it is achievable on a sustainable basis.
So I have a follow-up question on that. So do we enjoy any pricing power with our customer? And how much inventory we maintain with respect to consumables?
Sorry, I didn't follow you.
Do we enjoy any pricing power with our customer?
So see, we generally usually have long-term contracts with our customers, and our product is such that we don't really get into quarterly discussions on pricing with our customers. It's mostly on a long-term basis. Of course, if there are certain abnormal situations like right now, the freight has substantially gone up and certain commodity prices have also increased. So we are approaching our customers for price increase. So over the next couple of quarters, we should see better price realization.
Okay. And the second question on sales growth?
So sales growth, definitely, I think anything in double digit is possible. High teens is what we have always maintained, that we can grow, anything between 15 to 20%. And with, as you said, that industrial production picking up, we are very confident that this is possible in the second half of the year.
So are we winning any market share from our competitors?
Yes, we do believe that. We have been gaining competitor accounts also. And last year we gained some market share, but the results of this year for our competitors is not yet published on public domain. So we don't have the real figures, but our internal assessment does make us believe that we should gain market share in the previous financial year.
Okay, thanks a lot and all the best.
Thanks.
Thank you. A reminder to the participant, to ask a question, you may please press star and 1. The next question is from the line of Swechha Jain from NS Wealth. Please go ahead.
Hi, sir. Thank you for giving this opportunity. So I have a few questions. My first question is, would you be able to give us the revenue breakup in terms of the printers and consumables separately?
Yes. Should I give that, or you have more questions to ask?
I have more questions.
So I'll give this and then you can ask them. So for this quarter, our printers breakup would be about 18 to 19%. Our consumables is 51 to 52%. Spares and service would be about 23%, 24%, and about 6-7% on the mark.
Okay. So my next question is, like you said, you just guided to the earlier participant's question that we are looking at a sales growth of 15 to 20%. But so what I understand is the market size, the whole overall the industry size is just limited to 1,300 to 1,500 crores. Am I correct, sir?
As of now, but it is, as you know, it's growing for the industry.
Right.
So we hope in a couple of years they should touch 2,000.
Okay. So with that, I just want to understand, even if it's a 2,000 crore kind of an industry over the next 4 to 5 years, So do you think at some point in time our revenue growth would be capped at particular level? If not, then, if you could just give me some sense that how would our revenues grow over the next 5 to 7 years, given that the industry still remains like a 1,500 or 2,000 crore kind of an industry? So just wanted to understand, how overall revenue.
Our assessment is that, the industry should continue to grow strongly, and this should hit 2,000 to 3,000 crores in the 5 years that you're saying, maybe 2,000 in a couple of years. And Control Print, like we maintained, is trying for the market share of 25%, which today is at about 19 to 20%. So with a growing industry and our market share increasing, we should be in a strong position 5 years down the line. As of now, we are putting an immediate target to reach 300 crores in the next couple of years, and thereafter we'll go for the 400 mark. So from Control Print's point of view, I think maybe we can hit 400 crores in maybe 4 to 5 years.
Right. So I have 2 more questions. Can I ask them, or should I join the queue?
I think one more and then maybe you can join.
Okay, sure. I'll do that. So just wanted to understand with respect to the mask division, what are we looking at? I mean, do we plan to grow the mask division, or if you could give some color to this, sir?
So on the mask division, we've already made our investments, and the machines are already in place. We have our raw material and certifications also. So though we started the mask division in the pandemic as most of a CSR activity.
I'll answer that question if that's fine.
Yeah, please.
I mean, for us, it's not a strategic thing right now. It's there. What is there is there, if I may ask you. And how it goes, but it's not the focus. I think obviously That's
right. So no more.
And 98% is if you get.
Okay. So no further capex or anything on the mask division, right?
We did some this year, but that is only to get our certifications for the NIOSH and the FDA. But that is only because we do it as a company. We just take everything. So, but there's not like it's not like I said, it's not strategic to us.
Okay. Sir, I have 2-3 more questions, but I'll just join back the queue. Thank you so much.
Thank you very much. The next question is from the line of Devanshu Sampath from Yes Securities. Please go ahead.
Hi, good evening, sir.
Good evening, Devanshu.
Just a few questions from my side. So one is, it's great to see the working capital situation and the tightening of the same. Can you throw some light on what initiatives you have taken and whether this is something that is sustainable?
So Devanshu, I think Rahul might answer that better. I'll just leave that to him.
Yeah, Devanshu, like we've been discussing that, inventory is the main working capital part which we've been focusing on, and we have been able to, work on better inventory management in spite of higher revenues. So we have mentioned previously also that there is a minimum critical amount of inventory which needs to be kept to service our customers, as well as with the range of printers increasing, the SKUs increase for us. So now with increased sales, we don't need to keep adding up to the inventory, and we feel that even further increase in sales, we might be able to hold on to maybe the inventory levels. So that advantage we will keep gaining as the sales increase. On the working cap, on the receivables front also, we've tightened it up a little bit in terms of approaching our customers faster and putting some pressure for them to release our payments on the due dates. But not as I had mentioned previously also, we were not very bad off in terms of receivables. So that slight improvement there, but the major betterment has come from inventory side.
Okay, get that. And just continuing with the question that the previous participant was asking you, right? So I was just thinking about this myself. Maybe you can give me your view on this. So, while the coding and marking business is chugging along, right? It's 1,200, 1,300 crore kind of business, which you're expecting it to reach 2,000. And it's also fair to assume that it's not an easy business to replicate, right? Because you need a considerable support staff and network, which is required. But now that we have this in place, are we thinking about anything beyond this category, beyond coding and marking, to leverage on this network that we have? Any thoughts and plans over here?
Yeah, so, if I take that question, the market itself is growing at about 10 to 12% a year, compounded. Like if you look at it over a longer period, it might have been a little bit faster earlier. Of course, like the last 2 years is very tricky to predict because of the whole COVID situation. It's not, the market has not really grown, I feel, in the last couple of years. It's been quite up and down for us, since March of 2020. But, like overall, we related to manufacturing growth. So, as manufacturing grows, there will be a coding and marking growth, and obviously the second thing which, Rahul explained, same for us, is that, whether we're able to grow our market share in conjunction with the market growth. Now what we've seen is that, for, which I've mentioned some previous calls, as you get about $5,000 to $6,000 per capita GDP, the coding and marking, market grows at about 2 times the manufacturing growth rate. And then it slows down to about 1.5 times to reach about $10,000 to $12,000. And after that, the growth is more in services, not really in manufactured goods. So at that point of time, it sort of, tails the GDP growth. But it's like you said, there is a fair positive cash flow business without really much reinvestments required. So if you're talking from that angle, the profitability versus the free cash flow is quite similar.
No, I'm basically what I'm getting at is, expanding your market size, right? Like, okay, you have coding and marking, which is...
The target is to get from, we were about 18.5% pre-COVID if I take March 2020, is that correct, Rahul? And then, so we're targeting 25%. Now, the thing is, it's very difficult to predict what happened in the last few, like so much time, because first, our competitors are more for, they do file on the ROC. We've not got the results recently. And at the same time, it's been a little bit up and down for everyone. So it's very difficult to read what's happening in the last, so many months. I'll say like since the pandemic began. But obviously the idea is to grow the market share. And, like you said, beyond that, how to leverage our network. So we do have a very strong network. We do have some, potential thoughts of what we could do. But, when we have something very concrete, we'll get back to you on this. I'd say. In the meantime, the idea would be to run our business efficiently and definitely focus on growing our coding and marking market share. And that's where our focus is. So we were looking at some geographical expansions that sort of gone very, silent because of the COVID. We couldn't travel. We couldn't really, move it forward. Maybe in the coming financial year, we'll look at that again. We were looking at certain other countries. But we are continuously looking at new products and opportunities which are, allied to what we do.
Sure. So I was basically asking you a big picture question, like, maybe from a 3 to 5 year perspective, you're thinking about possibly, any other industry products that we can get into outside of the coding and marking. So that's what I was trying to get at.
So with the intersection of digital printing and the packaging industry, and obviously what the type of printers and the manufacturing technology and know-how we have is very related to the digital printing industry. But that's a very wide range, because even your billboard printers are digital printers, even your home office printers, your laser printers and inkjet printers are digital printers, for example. Then you have specialized applications, especially textiles and other things. So there are certain applications which fit in quite strongly with what we do. I won't really talk about that till we have something concrete out of it on the table. That's one area, and of course we are totally linked to the packaging industry, because in the end of the day, that's the customers we sell to. We sell to customers to package their products, organize packaging, and so those are the two areas, the adjacencies which are very close to us. So the option is geographical expansion or to get into these two sectors. If we can think of the right option and the options to take out.
Sure.
Sivanshu, just to add to that, we are just keeping our eyes and ears open, and if there's anything concrete, we'll update. But at the same time, I'll just say that if any of you feel that there is any opportunity, please do reach out to us.
Sure.
For inorganic options.
And so just a last question from my side. So, over the last 18 months, of course, the markets have been fairly favorable. They moved up quite a bit. And if you notice, Control Print's valuations have been still in the low to mid-teens band. And, relatively, for a business that we are, and steady business, earning the good return ratios and good balance sheet and everything. So just want to, if the management is thinking about sending out some signal to the market, either a buyback or probably the management probably looking at increasing stake. Any thoughts about this, especially considering that, we are generating about 30-35 crores of cash each year with no major cash requirement, as you said, to take us to the targeted revenue figure. So any thoughts on this?
Shivanshu, these are price-sensitive discussions, and we're not doing it on this call. Once the board takes a decision, we will inform the markets.
Yeah, I think, we have also increased our dividend consistently. And we are, I don't know what the percentage would be, but, we do have some sort of a dividend policy, distribution policy in place, in accordance with the rules. And so the idea would be, to make sure that if we don't find any opportunity in front of us that, cannot be available, then I think we would definitely reward shareholders. I can, assure you of that. But if we find, growth opportunities available, whether inorganic or, like I said, in adjacencies, and we have a definite plan, which we also can look at, then, we will also look at that. So that's my answer to you. But, at the moment, there's absolutely nothing concrete, and that would be something that the directors would, take that call on, if that situation came and, we have cash which we cannot deploy effectively.
Thank you very much. The next question is from the line of Shlab Agarwal from Snowball Capital. Please go ahead.
Good evening, sir.
Good evening.
My first question is, so we acquired a small company a couple of months back. It's a very small acquisition that we did. We acquired 80%. Can you just give us some sense on, why this acquisition was made? Were they making ink for us? Because it seems they are making ink for other brands also. So some insights into that will be helpful.
Sure, you'll take that?
Yeah, sure. So if you break up the industry structure, there's 4 organized players. That's us, and of course, Videojet,
Right.
Printing Sciences, and Markem Image. And the 4 of us combined about between 1,100 to 1,200 crores, depending on what their latest numbers are.
Correct.
And then the rest of the industry is about 300 to 400 crores. So it's a 1,500 to 1,600 crore industry. It's about 25% of the industry is in that what we call unorganized segment. And so essentially, the biggest company in the unorganized segment was a company called Jettings. They ran into some issues during the COVID time, and the CEO of that company quit because of some differences with the investor of that company. So I won't get into the exact reason, but essentially he quit, and he started his own business. And because he knows this area, it's an area which we are not really present in. You can say it's a more price-sensitive area, and so we have taken the option to sort of launch a second brand targeted at that segment of the market. But it's totally disconnected. So ControlPR is only like a manufacturing partner for this company. We own it, we are the owner of it, and we're a manufacturing partner, but it's not part of the ControlPR network. If you get what I'm saying, so it's more targeted, a slightly different segment of the market, is what I'll say, which we couldn't get into, without either lowering our service quality levels or and our pricing levels and so on and so forth. So but those guys are. Yeah, so there are sometimes the customers who are a little bit more price sensitive and who have higher service requirements and so on, or more of that. And then there are the type of customers we have who are more 24/7, and what they care about is that at the end they just want reliability, 1, 2, and 3, and then all the other questions come in. So that's
the Jettings brand will now be owned by ControlPR?
No. Jettings was the company that he was the CEO of, and he separated and started this new company called ICIPL. So Jettings, we have no connection with Jettings. It was just that he was the ex-CEO, so he has knowledge of this market. So we wouldn't do it if we didn't have a competent manager in place. That's what I would say. It's a different market. Slightly.
Oh, okay. So this CEO will work along with us.
Yes,
right?
He's the CEO of that ICIPL now.
Okay.
He was the ex-CEO of Jettings, and because that opportunity was there, and he needs growth capital, and it was fitting into us. And of course, we have synergies because we already have all the technologies in place to manufacture printers. We have so for us, it's a marginal. It's a marginal investment to just make a printer which is for that market.
But is this is this new company which has been acquired? Are they also servicing other brands for consumers?
Because that is what other brands, including us. So they are partly pirates, and they have now what we're doing is we're sort of moving them to their own brand of printers, separate from a ControlPR brand, is what I'll say. So suppose they were selling under the name of, I don't know, Samsung, now they started a new brand called Galaxy or something, so that's that company's Galaxy, or Huawei was and Honor, they run as 2 separate companies. We are like Huawei, and that's Honor.
Thank you very much.
Is that clear? I think, do you understand what we're...
So shall we go ahead for the next question?
Yeah.
Thank you. In the interest of time and fairness to all participants, please restrict your question to 2 per participant. A reminder for the participant, to ask a question, you may please press star and 1. The next question is from the line of Jayesh Gandhi from Harshad Gandhi Securities. Please go ahead.
Congratulations on good set of numbers, and thank you for taking my question.
Thanks.
Thank you. So I just want to I have a couple of questions. The first is the tax advantage which we are enjoying. Can you just help me out in understanding until how many years can we, are we eligible till that? 16 to 18% tax on the income. Until what years will we enjoy it?
So currently it is up till 2025 for our Guwahati facility that we set up. It was a 10-year tax advantage. But, on the cash flow, if we have to say that the MAT credit can be carried forward for 15 years after 2025. So maybe it can go up till 2040 depending on how much MAT credit we accumulate. As of now, I feel that we should cross about 100 crores of cash credit by 2025. So the MAT credit we are right now, it's only going to kick in after 2025. So till 2025, there's no question. It is purely paid on MAT basis. And after 2025, we will get the MAT credit advantage on the cash flow, which can be for another 15 years up till 2040.
Okay, I got it. And there is one line item which is finance cost in our profit and loss account. While we don't have any debt, neither short term or long term, can you just help me out in understanding what is that?
So this is the latest that Ind AS 116 has come up with, wherein whatever is on rental basis, if it is more than 1 year lease, then you have to split it between, you have to assume it as your deemed asset and have a depreciation on it and an interest cost. So basically the rental income, if you will see our previous maybe a year or 2 years earlier, you will find that there is a rental cost that we were paying for our offices across the countries, and that now has lowered and transformed into higher depreciation and some amount of interest. So it's like you calculate the present value of the next 5 years rental and account for it. It's the Ind AS 116, which is slightly more confusing. I don't know why they've gone into it.
I got it. And one last question, sir. While you said that you are expecting your sales to reach by, say, 400 crores in next 4 to 5 years, what kind of a capex will we require here?
So I believe up to 300 crores we should be comfortable. Beyond that, we will have to make some capex which will be decided at that point of time. So up till 2.5 years, we still should be able to manage without major capex. But beyond that, we'll have to evaluate.
Okay, thank you. Thank you, sir, and the best of luck for future.
Thank you.
Thank you very much. The next question is from the line of Saket Kapoor from Kapoor Company. Please go ahead.
Namaskar, sir, and thank you for the opportunity. Sir, firstly, if I could just, yes, sir, if I could sum up, sir, earlier in the call, sir, we were looking for that direction wherein we could be more confident of this being a linear trend going forward. So, do you feel that the fillers on the ground give us that confirmation that this the type of the highest turnover that we posted on a quarterly basis, the base can be now moved up, and this is not one of quarters?
Yeah, I strongly believe that this is not our best, and there is definitely scope of further increase.
Okay, sir.
Even at the current installed base, we should do better. The things have improved, but some of the industries where we have a strong installed base is still not at optimum, and we hope to see improvement in the second half.
Sir, you spoke about this dairy business part in sugar. So out of the total pie, sir, what percentage would we will be catering to them, sir, the dairy and the sugar business as of now?
See, honestly, sugar is seasonal. It's only from November to March, that 4-5 months that the industry runs. So I mentioned it because now we are in October and maybe the next for 5 months, we should get some additional revenues from that sector. So again, it's not a big pie, but next couple of quarters, it will be some additional revenues coming in. And dairy is definitely growing for us. Right now, it is not a very significant chunk, but as I've mentioned in all the previous calls, it is catching up and it has good growth potential. Right now, it will still be in single digits for sure.
Higher single digits?
No, not very high, but it will be like that.
It's not disclosed like, a very...
No issues, sir. No issues. When I look at the clientele profile, Mr. Kabra and Rahulji, I found all the marquee names. But in spite of that, sir, then why are the trade receivables part so higher? These people like JK Tyre, Cipla, Indian Oil, there also the cycle is so elongated that we have to wait. Just some understanding on the same.
So I really don't understand when we always question the receivables. Currently, our receivables in coding and marking business is at 67 days, which I don't think is something which would raise an eyebrow, because generally the terms, even with the bigger players, is 45 to 60 days. And once we consider the transit time from Guwahati to some of the locations, it is 10 to 15 days. So, people only start counting after it receives in their factory and the ERP system, books the bill. So I think 67 days is a good pan-India based receivable days.
Right, sir.
Working on it, it can come down by a few days, but it's not going to come down to 35 days.
Okay, sir. Because what I felt is that it is a necessary component, so we can never look for a cash and carry mode here. That was my understanding. Even it is the need because without that the production lines and all things would not proceed. So we can't command that kind of urgency in that sense. Depending upon this being a key component.
We can command the model that you're mentioning, but we like to be cordial with our customers, and because it's a long-term partnership, if we will over-pressurize them to gain some additional cash flows, we might lose the customer to our competitors. So I don't think that's a prudent strategy. We would like to continue with slight credit terms. It always helps in the long-term sustainable business. And our cash flows are not stressed, so we don't need to really disrupt things.
Sure. Thank you very much, sir. The next question is from the line of Anish Jobalia from Banyan Capital Advisor. Please go ahead.
Good evening, sir. Thank you for the opportunity to speak with you, and congratulations for the highest quarterly revenues as well as robust margins. So I would like to keep my questions related to the margins. Now, as per our presentation, we had a favorable product mix in this quarter, and hence, is there any reason which could help to understand the gross margin decline on year-on-year as well as business?
Just could you repeat the last few words, the gross margin?
Yeah, so just if you could help to understand why the gross margins declined on a year-on-year as well as a sequential basis. So, despite, favorable product mix.
It's like a slight drop. I do agree with you. Gross margins, there is a slight drop, but that is mostly because some of the components globally, that there is a shortage of the semiconductors, and a lot of electronic components are affected because of that, and an increase in the global freight rate. So these two components have definitely affected us, and the prices have gone up, which I mentioned that we are now starting to discuss with our customers to, pass on a marginal price increase. We haven't previously done it for the last couple of years, but now it's a scenario where we would like to approach the customers since it's a global trend.
Fantastic. So, sir, that this problem is likely to get corrected in H2, and because of which our margins are only going to be better, say, versus H1 at the.
So your voice is breaking. Yeah, your voice is breaking. So.
Better? Are you able to hear me now? Hello.
Yeah, I can hear you now.
Okay, thank you. So I just want to check, sir, that can we say that these problems are getting corrected, say in H2, because of which, the gross margins will actually revert to a higher potential than what we did in this quarter. And operating leverage also is likely to play in our favor because of that. The margins will be better in H2. Is that the right expectation?
So my view is that I think, Rahul and we hopeful that we should do better sales in the second half than we did in the first half, because we were badly affected in Q1 and even all the way through July, I'd say. So we are hoping for an increase in sales in the second half, but I have to be honest, as far as this issue of the components and the shortage we are facing of the microprocessors, it's only becoming worse right now for us to get all our semiconductors in place. We are paying a lot of premium to actually just make sure that our production doesn't stop. So I don't see things changing till for another 3-4 months. I don't know what's happening exactly. We're getting it, but we have to pay more money for everything.
So yeah, adding to what Mr. Shiva is saying, right now the market is very volatile, and getting components is our first priority. We have got some, things lined up, and they seem to be, it should not affect us as such in terms of supplies, but it has to be very closely monitored, and price is highly fluctuating. So at least for the next 6 months, we might have to still pay a slightly higher prices, and we're not sure if gross margins can improve.
Okay.
Maybe next year will be better visibility.
Yeah,
fantastic.
There's also some freight costs, I think. Rahul might say that, but I think also that has also affected us, not hugely, but to some extent.
Yeah, freights both for sea freights and air freights have drastically gone up, which again we are in discussion with our customers.
Oh, fantastic. So, sir, and if I were to...
I'm sorry to interrupt, Anish. Would you like to come back in the queue?
Okay, sure.
Thank you. Thank you. The next question is from the line of Jatin K from Alpha Capital. Please go ahead.
Hello, sir. Congrats for a good set of numbers. While most of the questions have been answered, just one question. What is our capacity utilization currently, and what will be the peak revenue at 100% utilization?
So at our printer factory in Nalagarh, we will be about 75 to 80%. And in our Guwahati facility, we'll still be at about 50-55%. But peak, according to us, should cross 300 crores. Beyond that, we will have to look at more capex.
Sure, sir. And so given we have good balance sheet, good as in debt-free and low free cash flow needs, so my suggestion would be we should, as in we are giving good dividend, we are maintaining around 50% dividend payout. Still, my suggestion would be, given the market price where it is, we should consider a buyback and all.
We will let the board know of your suggestion. Thank you.
Thank you, sir. Thank you and all the best.
Thank you very much. We have a next question from the line of Suvicha Jain from NS Wealth. Please go ahead.
Hi, sir. Sir, I wanted to understand with respect to the printers, that we sell. You said the life cycle is typically 5 to 7 years. So, wanted to understand what typically happens to the printer at the end of the life cycle. Second, does the customer has a choice to go back and install some other printer, or it has to be our printer? One was that. Second, I also wanted to understand that, typically when is the demand created for our printers? Does it usually happen when a greenfield expansion takes place, or even when a brownfield expansion is taken by a customer, our printers also play a role at that point in time?
Should I take those questions?
Yeah, sure.
Yeah. So just the first part, as far as the life cycle of the printer goes, normally it is more than 5 to 7 years. It's a bit longer than that. You could say the working life of a printer would be 10, 12 years. What happens, some of the biggest customers, maybe there's some industries like chemicals and fertilizers and of course cement and stuff where generally the life is short because the atmosphere is difficult. But what happens is normally after 5-7 years, a lot of prime customers, they tend to upgrade their printers because for them, absolute line reliability is critical. Most of the times, we give them some sort of like a discount when they change from our existing printer to, the upgraded printer. And in most cases, we refurbish the existing printer and then try to sell it. This we've not been successful in, but we are now trying to refurbish some of those printers and sell them as a sort of, like a cheaper option for some of the customers who could be more sensitive. And that's the first, question I hope I answered. And the second was, I think you were asking about where do these printers. So yeah, I mean, of course, in the end, all printers would have to be, scrapped and broken down and recycled. So, obviously we, if they come back to us, we do recycle them. We've got like the, what is that, the authorized recycling thing, the e-waste and all that. So we have all of that in place.
Right.
And there was one other element to your question. If you can repeat the end part.
Yeah, the last part was, when is the demand generated for our printers? Is it typically at a greenfield expansion or even when a customer do a brownfield expansion?
Yes, so any new manufacturing line requires a printer. So each line, because you're printing on the production line itself, so most customers, what they do is they set up a factory, and especially nowadays they acquire like extra space, with the view that I'll set up like say 5 or 6 production lines, and as and when demand keeps increasing, I've already got the space to keep adding like more sheds and more printers. So the brownfield expansion will continue for some time to come. And of course, greenfield is obviously always going to require printers. So both of those, as long as there's any manufacturing capacity increase, you require more additional printers for that. So both would cause an increase.
Also, just to add, Shiva, also on existing products which were not being printed earlier are now getting into printing. So even an existing factory can have a requirement.
So yeah, that is actually a big source of demand for us because in India there's still a move from unorganized packaging to organized packaging, and in organized packaging there's a move towards from pre-printed or older technology still towards digital technology. So that's also
Okay. So I just need 2 more data points. If you could help me with the number of printers that we sold in Q2. And the revenue from the mass segment. I think you did mention this number, but I kind of missed it out.
Yeah, so I think 20% of the revenue was approx from printers, and I think about 2-3% approximately is from the mass.
Okay. Yeah. And the number of
printers,
maybe in Q1 the mass was slightly more than 3%, but whatever. I think that's about it.
So the quantity of printers was about 750 plus, about 750, 775 printers.
Thank you very much.
Quite similar to the Q1 numbers.
Thank you very much. In the interest of time and fairness to all participants, please restrict your question to 1 per participant. The next question is from the line of Shlab Agarwal from Snowball Capital. Please go ahead.
Thank you for giving the opportunity again. Just circling back to to our earlier discussion, Mr. Kabra, this acquisition, is there any risk of any confusion getting created in the minds of our customers where we are selling a premium product, but we are kind of also backing a product which is into a market which has its own dynamics and it's probably not that premium?
So I think that the way we are positioning it is that it is a quality manufactured product, obviously through us, but in the end, the sales and service is totally different. So it's your choice. If you want the best, come to CONTROLPR, and if you want like a good product, which is a bit more reasonably priced overall in terms of service and price, fluids and everything, you can that's an option you can surely consider. So so there is always a chance, but there's a clear pricing gap between the two of us. So then it's really everyone's choice.
Sure. Is there anything more that we are looking to invest in this company going ahead? Will it require more investment from our side to really scale that business?
So right now it's in a loss-making phase as it grows, because I don't know if you all know our business, but if you don't hit a certain number of printers installed, the costs are significantly higher than your revenues.
Correct.
So I think it will continue to lose money till, I don't know, some amount of base is created, at least. It might not require the same amount of cost as, say, Control Print, because we already have the manufacturing facility and the logistics and all the other stuff. So relatively, the investment is more marginal for that company, for ICIPL, for our subsidiary. But yeah, there is surely an investment phase, and it is gonna continuously lose money for, I don't know how, whatever, Rahul, I can maybe.
I don't think for it will require anything large that we should be worried about. Maybe it's not something significant which needs for us to inform the investors. But yes, if there's a small requirement, we will definitely fill the gap.
Sure. And so lastly,
as of now, they're getting their own bank finance also, so they should be self-sustaining.
Okay.
Mr. Agarwal, please come back in the queue.
Sure, I'll do that. Thank you.
The next question is from the line of Saket Kapoor from Kapoor Company. Please go ahead.
Yes, sir. So with the economy picking up, any update on the real estate part of our the subsidiary Liberty Chemicals? And sir, in addition to that, from the OCI part also, other comprehensive income, we have seen this time a loss. Markets have remained buoyant over this quarter. So if you could explain or throw some light on the same.
So I'll just give the first answer. Mr. Kabra himself is looking at the entire real estate thing, and he's not here today. To my knowledge, there's no real movement in the whole Chandivali land plot. There's some litigation we're trying to get to this court, and the thing is, the whole court system has stopped, frankly, for the last, at least for like non-urgent cases for the last 18, 20 months. So that's not really moved one way or the other. Maybe I think now things, hearings might start again, and courts might go back to normal. Maybe some movement there. And as far as the OCI goes, Rahul might give you a better reply on that.
So, Saket, on the OCI also for this quarter, it's a very small amount. It could depend on how our portfolio played out towards the end of the quarter. But the amount is small, but I would request you to look at half year, where we are 2.63 crores positive. So quarter, I'm not too sure, but half yearly we still.
Sir, actually, why I dwelled on it was that our portfolio stock selection is we are beating the market in all terms. When I looked at the portfolio in March, when the annual accounts were there, so that was a surprising part, because the market have moved up significantly. So there should have been significant gains in that way. So that was my reason. Even on a quarterly,
we've done gains, Saketji, in half year.
Yes, sir, I've seen it.
Yes. Most of the gain, according to me, had come in March 21 itself, where we were, you know the figures. And since this is mark to market, you can't have the same thing growing at that rate every quarter. But if we see the last year, it was a big gain, which was already marked to market. So you have to see it from March to September. Again, we have gained, but of course, that again, it's a market thing which you know better.
And the list is available for us.
We've been, increasing our exposure in this market, and further, of course, again, this is a board of directors thing, and Mr. Kabra looks at specifically, but I don't think we've had too much churn in our portfolio that we've been doing. So maybe, some things gain and then they're sort of stagnant, and so on.
But you have to compare it, Saketji, mark to market. You can't compare it from last year because we've already marked it in the books up till March. And Correct. Then now it's only March to September. So Correct. Whatever, these are the figures that are there.
These are audited figures, so they have been done away. Sir, a small point more, sir. We paid income tax.
Kapoor, I am sorry to interrupt you.
Yeah, income tax also for 4.5 crore. Attributed for this year only, or prepaid expense item also?
No. It's always for this year. I didn't get the question.
Sir, I was asking that for the first half, our income tax payment is to the tune of 4 crore 45 lakh rupees. So is this entire amount attributable to this year's performance only, or does this have any other tax paid which was due for earlier years, any assessment and all?
No, if it was earlier year, it goes into prior period. It will not come into current tax.
Okay.
So 4 crores is for current year.
Current year. So that gives an indication. Thank you, sir.
Yeah.
Thank you very much. The next question is from the line of Anish Jobalia from Banyan Capital Advisors. Please go ahead.
Yeah, hi. Thank you, sir, again for the opportunity. My question around margins, I could not complete last time. So, if I were to again think from the longer term perspective, and you have, you're already confident of reaching, say, 400 crores of revenue in the next 5 years. Plus, Rahul sir has been saying that, the sustainable margins are 24 to 28% range. So, it would be very helpful to understand from you that how should we think about the margin trajectory going forward, given that the revenues are on an increasing trend. So can we expect that the margins also trend along with that? Because our incremental contribution is from higher margin products, like the new products that we have, like TIJ, TTO, etc. Plus, there's also an operating leverage potential. So how should we think about, say, over the next 5 years, what can our margins be in the base case, like in a realistic scenario?
So my belief is that, the margins will should increase as sales increase, both slightly at the gross margin level, I'm talking like, if you don't look at it over like 1 quarter, 2 quarters, but
sure, I mean, yeah,
last like 3-4 years profile,
absolutely,
it should slightly increase as we get more leverage and more fluids, more consumables and service business as compared to printer business. And as far as the, EBITDA, we would, or rather the SG&A, we would expect a higher operating leverage there because we already have a full team of manpower and, factories and a lot of other expenses have been already included.
Sure.
For a bigger jump in EBITDA margins. But of course, because of, like fluctuations that happen like right now, with the whole COVID situation and, whatever the knock-on effects in terms of, cost of parts and freight and all these. So like, there can be, of course, changes, from quarter to quarter. But, we're too small a company to frankly evaluate it at such a, a very quarterly basis.
Sure. So, but I mean, if we were to think about, say, margins when we do 400 crores, would it be possible to pencil it down to more narrower range to think about, considering your business?
As of now, the visibility is this 24 to 28% which I mentioned is sustainable even with increased revenues. As of now, but things are very dynamic and keep changing. If things improve more than that, we will be happy to.
No, sure, I understand, but even with 28%, is it more realistic to assume that when you reach 400 crores, our margins will be closer to that, or it will be still in a very broad range of 24 to 28%? And why is it such a broad range that you are looking at? Because there are not too many factors that kind of impact our margins. Given that we are a high gross margin.
See, it's always based on product mix. If the consumable portion, like you said, the higher profitability sells more in a particular quarter, you will find it closer to the higher band of 28%. And if the printers sell more, it will be on the lower band. So I think 24 to 28 is not a very large band, considering that there will be change in product mix quarter to quarter, and even on the long-term basis, I think we are inching up towards the higher percentage. It all depends how much our consumables are sold based on the industrial production. We are confident if higher the consumables, we'll be closer to 28%.
Okay, fantastic. Thank you, sir, for sharing your thoughts.
Thank you very much. The next question is from the line of Shalabh Agarwal from Snowball Capital. Please go ahead.
So thank you for giving the opportunity again. Sir, at the industry level, are we witnessing, because Rahul had mentioned that, there has been a cost increase because of various factors. So at the industry level, are we witnessing our MNC competitors, increasing prices of their products in the market?
So I think in the last 18 months, it's a bit, nobody's really done too much of anything because of, everyone has been preoccupied with just ensuring their supply chains and their service and, the safety of people. So I wouldn't say like right now there's been a change, but now, people will all have to employ the strategy because, like if our costs have increased, I assume, I won't say, but I assume that there might have been a similar effect for our competitors,
Sure. And if they are not manufacturing here, then their costs would have probably gone up higher compared to us, right?
So normally they're importing primarily from China, but I don't know offhand. So we've not tracked them very, very closely in the last 18 months, and we've not got the data from the ROC either. But it's difficult to say because everyone has their own transfer pricing policies also. So that's a little bit of a hidden mix. We don't get a straight naked cost and cost plus pricing, so it's difficult to say.
But at the ground level, the prices are still competitive. If they have borne, maybe they're taking an extra hit because their costs would have gone up more than ours. But they're able to get better pricing, but still competitive.
I think so far everyone's not really changed pricing much in the last, 16, 18 months or something. 18 plus months now, is what I'd say.
Sure. And so these MNC players, they have this global tie-up with big FMCG companies, as in if their supply is placed at a global level and then distributed to different factories. How does it happen?
So normally they do have some preferred supplier tie-ups in some cases. So there are some companies like Coke and Nestle or P&G who do have that, but it's not like a, like when it comes to big operation like India,
right.
Then everyone wants their own local service and support and whoever they are most comfortable with. So there are a lot of companies like Unilever, or Pepsi or so on, where we supply a lot of printers there, even though they do have like some sort of a tie-up, because in the end, it's not a monopolistic thing. It's like a preferred supply arrangement, and preferred could depend on what the local factory manager prefers. So in the end, everyone will go for whatever they think is their best supplier, and but there are loads of companies like Ferrero and so on, like who do have some Lactalis, who do have technically a tie-up, but they are using our printers largely. So I think so sometimes those things matter, but I wouldn't say like it's in the end, like if everything works smoothly, then nobody cares is what I'd say. And in general, Indian pricing frankly is much lower than the global pricing arrangements. So even the local companies like to ignore those arrangements, because if they give the global pricing here, they won't have any sales, because obviously we sell at X and they are selling at X, and the global agreement is like 2.5x, then why would they buy that?
Thank you very much. The next question is from the line of Sunil Patel, an individual investor. Please go ahead. Mr. Patel, please go ahead with your question. As there is no response from current participant, we'll move on to the next question. That is from the line of Saket Kapoor from Kapoor Company. Please go ahead.
Yeah, Rahulji, you told about this non-LCP business. I missed that link. What were you trying to convey? That more thrust will be there or lesser thrust will be there on the non-LCP business? I missed the point completely.
No, there will be more thrust, because as you know that cement has been diminishing for us. So there has been some revival and we could contact some customers. But that team is still now trying to promote like some new products in the steel segment. The sugar is what they have only developed. So the team which was more focused on the cement side is now putting their energies on sugar as well as some steel new. So if you open up a new product, it gives us good revenue. So that has shown some green shoots at this time.
Thank you very much. The next question is from the line of Karan Bhatia from Asian Market Securities. Please go ahead.
Hi, thank you for the opportunity. Rahul, you keep mentioning about the new launches, TIJ, TTO, High Rise. So it's good quarters that we've had in the portfolio. So today, what contribution to the total volumes or revenue has it become? So just a ballpark number, can you help?
These are inching up, and now they should be definitely in double digit, closing into about 15-17% in that range.
Great. Yes.
And we have good hope from them even in the future.
Right. And just last bit on the depreciation policy, we were hinting to deplete the mask project by this year. So incremental 1.5 crores per quarter depreciation, correct? Or we want to keep the mask project ahead as well?
Yeah, I think a couple of years more it will require.
So this 4 crores of quarterly run rate stands, right?
Yeah, at least for the next 1 year or so.
Okay. That's it. I think we don't have any other further questions. Any closing comments, Rahul or Shiva, you want to make?
I think, yeah, first, thanks for everyone to spend a lot of time and effort taking our call, especially in this busy season. And a happy Diwali and a safe Diwali to all of you all. As far as we are concerned, I think things are now coming back on track. It's been a bit of a difficult 18 months or so. But it seems things are normalizing. I don't want to say anything because, last time we said the same thing and we all know what happened with the second wave and so on. But I hope that if there's no COVID, then, the market goes back to normal and we are able to capitalize on the strong product portfolio and the strong team and strategy that we've created, which we didn't get to really take in place before COVID disrupted us. So I'm really hoping positive 18-month period, and by then I think a lot of people will have questions as to what's next, or are you going for the buyback and stuff. And I think at that point of time, those questions will become more relevant as to what the next steps would be, the next level from 400-500 crores to the next size.
Yes. Thank you everybody for your participation in this busy earning season. Current tells us there are 10 calls which are today between 4 and 5. So thank you all for giving the importance to Control Print, and wish you all a happy and a safe Diwali. Thank you. Thanks, Karan.
Very much.
And thank you, management of the Control team.
Thank you. Thank you, participant on behalf of Asian Market Securities. That concludes this conference call. Thank you for joining us, and you may now disconnect your lines.